the halvings that are the key mechanic to bringing attention to Bitcoin every 4 years, because it sets in motion this price discovery and forces the rest of the world that is yet to adopt Bitcoin as part of their savings plan to reconsider, am I about to miss this again? Because I missed it in 2021, I missed it in 2017, I heard about it in 2013, I thought it was crazy then, but I missed it then too. Am I going to miss it again in 2025?
The dollar is a monetary technology that is designed to debase. Like all other previous monetary technologies that have ever existed, humans are going to find a way to create more of it. In the long run, it's pretty obvious. The supply of dollars is going to exponentially increase for all of eternity. And then Bitcoin is going to be this one monetary technology that is not going to exponentially increase. It's going to exponentially decrease over time, and eventually it's going to trend to zero.
What's up, Sats fans? Welcome to Swan Signal. We got another great show for you guys today.
If you care about your financial future, you need to check out a couple of our offerings, including Swan IRA and Swan Private. Swan Private is our white glove concierge service where you get a trusted partner on your Bitcoin journey. We offer all kinds of education and research projects, as well as exclusive events to our Swan Private customers. Check it out today at swan.com/private. Also, Swan IRA. Swan IRA is the best way to gain exposure to real Bitcoin in a tax-advantaged account, like a traditional IRA, a Roth IRA, or rolling over your 401k. So if that interests you, check it out at swan.com/IRA today.
Two excellent guests, some of my favorite writers and thinkers in the space. We got Joe Burnett. He's the head analyst and product manager at Blockware Solutions. And we got Jesse Myers, also known as Croesus BTC on Twitter. He's the author of the Once in a Species newsletter and the new COO of Onramp. So welcome, gentlemen. How are you? Welcome to the show.
Thanks for having me.
Yeah, thanks for having us, Sam. Feeling good, feeling bullish.
Feeling bullish. Yeah, so I was kind of talking to you guys before. Over the years, you guys both make me feel super bullish long term because you guys kind of zoom out a lot and make us aware of kind of the big picture of where Bitcoin could go using different various models. You know, Joe, I saw it one time you said 50 million per Bitcoin is one that you threw out there one time. And then Jesse, you said that I believe that Bitcoin is on track to 500x over the coming decades in real terms, inflation adjusted. So how are you guys feeling today? I mean, Bitcoin has rallied up to 30K. It's kind of dropped down. It's kind of funny. People are kind of screaming now that it's down to 27K, but that's kind of what we're feeling right now in the sentiment. But how are you guys feeling? I'm just curious. Maybe throw it to Joe and then Jesse next.
Yeah, absolutely. When I think about Bitcoin, I always think about Bitcoin from a long-term time horizon, right? As you just mentioned, like, I think trying to predict the short-term price action of Bitcoin is kind of a fool's game. There's a lot of random noise, and we don't really know what's going to happen in the next 6 months, in the next 12 months. But I know, most likely within the next 4 to 5 years, Bitcoin's going to be significantly higher than where it is right now. So yeah, in the short term, I mean, I wouldn't be surprised, or I would say it's very likely that we obviously bottomed last year around 16K. But going forward, we could experience some turbulence, right? Like we have interest rates are relatively high. The Fed's not going full blown, pivot per se. If the Fed does and we go to 0% interest rates and the money printer comes back on and physical stimulus occurs, then maybe Bitcoin will begin its next parabolic ascent. But I think in the short term or maybe for the rest of this year, I could see Bitcoin being relatively flat or just volatile, not too much upside, but not too much downside either.
Yeah, I agree with that overall view. I think what Joe said at the beginning there was that there's so much noise. There's just so much noise with Bitcoin, and that makes it so it's kind of impossible to predict what's going to happen on a short time horizon. It could go down. We could go way lower. It's always possible, March 2020 going into the last halving, suddenly overnight we dropped 50%. Who knows? Right? That could always happen. But last cycle, so I tend to think that the signal underneath the noise is what's going on with the halvings. and how increasing scarcity, meaning the reduced issuance of new Bitcoin every day, as per the protocol every 4 years. That is, I think, setting the supply-demand price equilibrium over any given 4-year period. And this is tantamount to stock-to-flow model. I think that the stock-to-flow model was wrong to have such defined price targets, when in reality, it's, increasing scarcity here is it's an organic process that has to incorporate the change to reality of supply issuance and how quickly human civilization can adjust to those changed conditions. And that takes more time than 4 years, probably. That it takes generations, I think, to really properly price in. All that to say that, I think I think there's some sort of stock to flow movement happening with the price over multiple cycles. But where is that price equilibrium for right now? Maybe it's at 30K, maybe it's at 40K, but where is it going to be in 2 years, in really beginning in a year, when the halving happens in 12 months exactly, right? Like, we are within a couple days, it is exactly 12 months away from the next halving. And then, we're mining 900 Bitcoin per day right now. In 12 months, it suddenly becomes 450 Bitcoin per day. At the current price, it means that we are, that is $900 million a month that has to come into the market, in order for the price to stay at 30,000 every month on net. That's what has to happen to support a $30,000 price level right now. And in 12 months, the amount of Bitcoin being created gets cut in half. Suddenly it's 450 a month, that's needed. But there's still, in theory, will be $900 million net coming in on average to try to buy up not as much supply being created. And the only way for that price equilibrium to be reestablished is for the price to drift upwards. So, that's the signal underneath the noise of the price action with Bitcoin. And it's impossible to know where we're going to be a month from now. But, to Joe's point, 12 months from now, we know what happens. And we know that those supply demand price mechanics will play out to and affect some degree of stock to flow price shift, as the equilibrium moves upwards. So that's what I'm here for.
Yeah, just to add on, I think a lot of people are just very short-sighted, right? Like, you look back to March 2020 and you look back to the 2018, 2019 bear market, Bitcoin was trading in the $3,000 range during both of those times. And, 3 years later from March 2020, Bitcoin was dead. FTX was imploding. The entire crypto industry was just getting destroyed. And Bitcoin was just hovering around 16K, which is, over 5x above $3,000. And so I think if you really zoom out and you look at the history of Bitcoin price action, look at the history of Bitcoin adoption, the trend is super obvious. And it takes, some macro bullishness to really move Bitcoin higher. And then it also, these halving events, like Jesse was talking about, act as these sort of catalysts that really kind of push Bitcoin to the next level. And then when you have some sort of macro fire underneath, that just really sends Bitcoin into another parabolic bull run.
To add on to that, like, last cycle comparison, I think what the stage of the cycle, the 4-year cycle that we're in right now, is analogous to what happened off the bottom in spring 2019. I guess from the beginning of 2019, we had a 7-month rally from 3K to 12K. So crazy, 4X. That was coming off of the bottom, right? Like, we bottomed out, fear was peaking, the Bitcoin was dying, everyone wanted out. All the tourists left, and all the whales bought Bitcoin at the bottom, and then suddenly everybody's stuck on the sidelines bidding it up, without any sort of relief, no dips along the way. And I would know that because I was one of the people on the sidelines who got caught watching it run away from me, and eventually capitulated into it. And we're sort of living through like the same dynamics now of like, we went through a year-long bear market, fear snowballed to a peak fervor, with FTX imploding, and then we bottomed at 15K, and now we've 2x'd, but we haven't 4x'd. We probably won't 4x, but there is an argument to be made that, like, maybe we 3x, maybe we 2.5x, and there's still some upside before, as people are caught on the sidelines. The reality is a lot of people were hoping to buy at 10K, and they're now stuck trying to, in absolute pain, wondering when is their opportunity to buy cheap coins, and Bitcoin might not give it to them. And that's the maximum pain for the maximum number of participants is what Bitcoin tends to do. So I wouldn't be surprised if we keep running to 40K and then settle out, 35, 30K over the next year before the mechanics of the halving send us to six figures.
Yeah. It reminds me, it feels a lot like 2019. And whereas 10K was the 1,500 that everyone was waiting for when it was around 3K in 2018, and then Bitcoin just rallied all the way up to 13K. And so it just reminds me a ton of that year. And so it just left a lot of people on the sidelines when everyone was kind of waiting for it to dip another 50%, like from 20K to 10K, and it just kept and ran away from them. So these halvings, there's so much debate around them. Bitcoin's the supply is fixed. So other people say, well, is this correlation or is this causation? Like, certainly historically, we've seen the price run around these halvings. But it's kind of difficult to have a model where you don't consider Bitcoin's demand side as well. And so we're a little over 75% into this halving epoch, a little less than a year until the block rewards cut in half again. So do you guys think the halving is priced in? And do you think that this model is actually accurate to kind of think about when you don't consider the demand side of the equation?
Yeah.
I'll throw it to either one of you guys. Yeah.
Jesse, you want to take it, or you want me to start? And
Yeah, go for it, Joe. I'll end up ranting. Okay. So
fair
Yeah,
enough.
no, I love it.
No, yeah, this is like something that is so fascinating to think about to me. I know Corey hates the stock to flow model. I guess looking at it statistically speaking, maybe it's technically invalid. But my view is that these halvings are still bullish catalysts for the price of Bitcoin. And they're kind of that, ignition to really get it moving. And once Bitcoin gets moving, like, there's nothing that drives Bitcoin adoption than the price going up, right? It's kind of this reflexive feedback loop where as the price goes up, more people learn about it, more people get interested in it, more people buy it. And so I think there's basically three reasons why the Bitcoin halving is quote unquote not priced in. Is one, I think if people are trying to price in the Bitcoin halving, meaning like bid up the price today, if say the price of Bitcoin is $1 million today, that's going to be a ton of hash rate, a ton of mining investment that's going to have to come online. And markets are relatively efficient, right? So if the cost to produce a Bitcoin is, $20,000 or $10,000, and price of Bitcoin is $1 million, that's going to be so much gigawatts, so many exahash of hash rate that's going to come online. As that hash rate comes online, those miners are going to at least be selling likely to cover their operating expenses. And so as more and more hash rate comes online, that sell pressure in dollar terms drastically increases. And so it kind of gets to a point where it's like, okay, if Bitcoin's trading at $1 million, that's like billions and billions, maybe even like $1 trillion per year of sell pressure, which would just be insane. And that would require a lot of people buying Bitcoin like over and over again just this year or early next year. So that's one reason why I think halvings are priced in. The second reason I think is when the halvings do occur, and Blockware did really great research on this back before the 2020 halving, miners, the weakest miners on the network are the ones that get purged from the halving, right? So the miners that are running at high electricity rates or running old generation machines, those are the miners that end up turning off. And those are the miners that are actually selling the most Bitcoin right now. If you're running the latest and greatest hardware and you're operating at some of the lowest energy rates in the world, you're mining a lot of Bitcoin and you're not selling much Bitcoin. The inefficient miners, the ones that are running those old gen machines at a very high electricity rate, those are the ones that get knocked off the network. They capitulate, and then the only miners left after the halving are the ones that have very low expenses, and they sell little Bitcoin. So that's the second reason why I don't think the halvings are priced in. And then three is people think Bitcoin is insecure long term, right? So after each halving, eventually the block subsidy is going to trend towards zero. Some people say, hey, well, Bitcoin simply won't be secure when that's the case. And so after each halving, when Bitcoin simply doesn't die and the price doesn't go to zero, and people can continue transacting and they're comfortable, settling Bitcoin transactions after 6 confirmations or 10 confirmations or whatever it might be, the fact that it doesn't die proves those people wrong, and therefore, they may want to buy some Bitcoin. So I think those, in my opinion, are like 3 reasons why Bitcoin halvings are not priced in. Would love to hear Jesse's thoughts.
I really like how you included the fact that it doesn't die helps show people that Bitcoin's here to stay, and that maybe they should stop dismissing it. I think that, and I agree with all the things you said. There are all these little tiny mechanics that play into why the halvings mechanically drive up the price. Even though stock to flow is technically invalid, it is still, I think, a directionally true concept. The prescriptive targets never should have happened, I suppose. But I think that what Joe was getting into there with the idea of how Bitcoin not dying, it helps Bitcoin adoption, is kind of the key for me, because Bitcoin's so new on the global asset landscape. It's so foreign to people, and it requires you to take a big leap into something that nobody's really comfortable with. This is we're physical beings, and we like trusting physical assets. And you're telling me I have to put faith in ones and zeros and put faith in code that I can't possibly understand, and trust my savings into something like that. That's a scary leap to make. But as time goes on, this Lindy effect of the longer it's been around, the more likely it will continue to be around, plays in. And I think each successive halving cycle, we've only had 3 halvings. It's hard to really paint a clear picture, a confident picture with 3 data points. But in a year, here comes the 4th data point. And when these mechanics play out again, suddenly you're talking about 4 data points rather than 3. You can barely draw a curve with 3 data points. And so that will help clarify the picture a great deal more to people who are currently on the sidelines or on the fence about whether or not Bitcoin is legit. And I think that's where it's helpful to think about how early it is in adoption still. One of my earliest contributions to the Bitcoin community was doing some quick back of the envelope math about where we are in the adoption curve, and how the expected adoption S curve compounds with the exponential decrease of supply issuance to create what I called the adoption adjusted scarcity of Bitcoin into the future, which is to say, how many sat stackers are there right now, and we're all competing over 900 Bitcoin a day. And then if Bitcoin adoption continues and this becomes, a major savings vehicle for the world, how many sat stackers are there in the future when an eighth as much Bitcoin is being created, which is only in an eighth as much Bitcoin is only 9 years away every day. And then, it might be billions of people that you're competing with at that point. So, looking at the numbers and seeing, luckily we have on-chain data that tells us how many people have a certain amount of Bitcoin. And right now there are 4 million addresses who have 0.1 Bitcoin or more in them. And it's not a perfect metric, because you can have more than one address. You can be on an exchange, and that's a bunch of people are counted in a single address there. But call it 4 million, call it 10 million, whatever you want. That's still a tiny slice of an $8 billion person world. So, in terms of where we are in the adoption curve, we're still in the first fifth of the innovators category. The very first part of the adoption curve is at 2.5% of the population is innovators. Then comes your early adopters, then your early majority, late majority, and laggards. And that's how technology is adopted. There's people at the bleeding edge who do it first, who establish it, who show that there's some value there, that, actually I'm getting a lot of use, a lot of value out of adopting this thing, and their friends notice it, and then they're propagating the message to people in their network, and then more people adopt it, and it moves its way through the bell curve of adopters. We're still at the very, very beginning of that process, and I think how each halving occurs and then doesn't kill Bitcoin, and in fact drives the price up, that picture becomes so much more clear once we have a fourth data point. And that's how we are going to shift from the innovator stage, where we still are, to the early adopters stage, which is still a huge opportunity for people who get in then. And so I think it's the halvings that are the key mechanic to bringing attention to Bitcoin every 4 years, because it sets in motion this price discovery, and forces the rest of the world that is yet to adopt Bitcoin as part of their savings plan to reconsider, am I about to miss this again? Because I missed it in 2021. I missed it in 2017. I heard about it in 2013. I thought it was crazy then, but I missed it then too. Am I going to miss it again in 2025? And I think that's the question that people are going to be facing this time next year.
Yeah, this might have been from one of your pieces, actually, Jesse. But you kind of talk about how early we are in Bitcoin's adoption, because how many people actually own, let's say, a significant amount of Bitcoin as a percentage of their net worth, but also understand what they own. And so how many people are educated to what they own with this new crazy digital money that's never existed before, this magic internet money. But when we think about valuation models, and a lot of people have thrown out these valuation models of all kinds, and you guys both kind of think about these things very, very differently. And I know, Jesse, you kind of look at more like total addressable markets of different asset classes, of like stores of value, and how Bitcoin can eat the monetary premiums away from these asset classes. But I really liked one thing you said, and you said a piece of the puzzle that usually goes unaddressed is different assets have different ceilings, meaning the percentage of the global asset pie they could ever realistically be in terms of their size. And I was wondering if you could maybe dig into that a little bit for our listeners.
Yeah, totally. That's a fun question, because it's a little detail in that piece. So I guess the example that I would call out is art. So fine art is a $17 trillion store of value bucket on the global asset landscape. All of the store of value buckets together add up to 900 trillion, and Bitcoin is a 0.5 trillion bucket. So it's 1/2000th of the world's total value is stored in Bitcoin. So 0.05% of the world's value is in Bitcoin. Fine art is a $17 trillion category, and that has a ceiling, because there's always more art that can be made, and you can of course say, well, there won't be any more Monets, there won't be any more yada yada, but there's modern art. There's always more art being produced, and there's all these games around how that art is valued, and because of that, it's kind of hard to really trust what you're storing your value in, specifically because you can always make more of it. More Jeff Koons pieces could always be made. More Picassos can always be surfaced. These old artists used to doodle on checks, knowing that they wouldn't be cashed. Who's going to surface one of those and add to the supply of however many Van Goghs there sketches there are in the world. It's hard to trust the finite supply of an asset class like that. There's so many unknowns, and there's always more supply being created. If the value of fine art was to double, what would that do to how would that incentivize producers of art? Would would modern artists today be like, oh well, I'm going to keep creating just as many pieces, and nobody else is going to get into this space and add to that supply as well? No, it'd be the opposite. There'd be a gold rush of people trying to create more supply in order to cash in on the sudden interest in storing value in art. So that's why there's a ceiling there. This has just been an organic process. It's just human nature playing out over millennia. But we know which buckets we trust because they're more or less scarce in terms of their new supply creation. And that's why gold was the winner in the physical realm as a store of value asset, because it was really hard to make more gold. You can make more art. If suddenly there's more interest in art, you can easily spin up more art. But you have to go mine gold. And that's why it was the winner. And in 1980, in 1980, gold was the world's gold was worth $2.5 trillion. And all of the stocks, all the equities in the world was worth $2.5 trillion in 1980. So they were at parity. And of course, now gold is 13 trillion, whereas equities has jumped to 115 trillion. So a 10x roughly outperformance of gold over the last 40 years, with interest rates declining, and that causing a bull market for financial assets. So these ceilings, they shift over time, but they are the outcome of human nature pricing what we value, and what we have come to trust as assets that can preserve our value, specifically because they have a certain degree of scarcity baked into their supply mechanics. And that's where Bitcoin flips everything, upends the table, because here's an asset that gets more scarce every 4 years until it reaches absolute scarcity. And there's never been anything in the physical world like that. And so, collectively as a species, we are having to figure out what this means for us. And I think we're at the very early stages of everyone coming around to realizing that this is the best savings vehicle out there.
Yeah. I mean, in a way, what you're kind of hinting at, I guess, is in the long run, there is no ceiling for the price of Bitcoin denominated in worldly items, which is pretty kind of fascinating if you think about it, because everyone's kind of searching for some sort of technology to store their wealth, whether it's equities, real estate, fine art, whatever. And they've tried to pour money or capital into these things, and the world spits back out more of those things, whether it's more equities, tech startups or whatever, more fine art or more real estate. And now we have this one asset that no matter how much time, energy, or resources are poured into creating more of it, you can't create more of it. And so it's fascinating to see how this is going to play out.
Yeah, Joe, I've heard you say something along the lines of not only should Bitcoin's share of the pie keep growing as it takes the monetary premiums from these assets that their supply can fluctuate with increased demand, but the pie itself is about to grow by orders of magnitude. I saw that tweet and I just wanted to hear more about that. So maybe you could divulge a little bit.
Yeah, absolutely. So, I mean, I look back at other technologies that have existed in the world, right? When the telegraph was invented, or Alexander Graham Bell invented the telephone, right? Like, the world got wealthier because of that technology was created. And so I think Bitcoin is just another technology that has now been created. And we're trying to I definitely like Jesse's idea of, and I think it's like a great, starting point, I guess, for the next 20 years of like what Bitcoin could become. But it's like when you look back at those other technologies, they definitely grew the pie of total wealth of what, was possible with the telephone or the telegraph or the internet. And I think Bitcoin is no different, right? It's a new technology that was created that enables people to save for the future without being diluted. And it's very likely that, like every other technology that's been created, it's going to end up creating more wealth in ways that we probably can't really imagine than exist today. So like saying that, Bitcoin takes the monetary premium out of equities, real estate, fine art, is definitely highly accurate. And I think that's, going to happen. But I also think that the pie itself, the total global wealth, is going to probably expand by a significant amount. And in my opinion, a lot more than many people expect.
Yeah, new technologies usually cause increases in productivity, which lead to higher economic growth, increased wealth for all. So, I mean, it makes a lot of sense to me. And this concept, our CIO, Hafa Saguri, just came out with a model called Schrodinger's coin, where basically Bitcoin has two possible outcomes. Either it's fails and it's going to be completely worthless, or it captures the monetary premium of these traditional stores of value. And so, it's actually what Satoshi said too. Satoshi was like, "This thing's either going to be worth nothing or it's going to be worth a ton." And so you can check that out at nakamotoportfolio.com. It's an open source project that we're working on, but it kind of delves into this model. And Joe, like I wanted to talk to you about your model that you kind of made, because it's very different. And that's why I love Bitcoin. There's all kinds of different ways to look at it, and your model looks at energy, right? So like the mining side of things and the Bitcoin energy gravity model. And I thought it's fascinating. It's just a new way to kind of look at the price, and really kind of a different kind of denomination, even of everyone's looking at the fiat price of Bitcoin, but you're just look at the energy. And so maybe let's talk a little bit about that.
Yeah, definitely. I mean, a lot of it goes back to what we were talking about as far as like the stock to flow model. The general idea behind the energy gravity model was Bitcoin is a commodity. It's not very different from other commodities in the sense that if the price is $1 million a coin and the cost to produce Bitcoin is $10,000 a coin, people are going to start mining Bitcoin, and potentially people are going to start selling Bitcoin, right? The cost of production and the price of an asset are likely going to eventually combine or trend towards each other over time. If there's an arbitrage opportunity, someone in the market of the 8 billion people in the world are going to take it. And so the general idea is Bitcoin is a little bit unique compared to other commodities because we have the difficulty adjustment, right? So if, for example, the price of Bitcoin went to $1 million a coin tomorrow morning because everyone that held Bitcoin today for some reason decided to not sell it, what would happen is mining companies, we would see a massive inflow of capital into manufacturing ASICs, building mining infrastructure, getting the transformers, getting all of this, stuff that is needed to mine Bitcoin, like signing energy contracts, potentially even building power plants and stuff like that if Bitcoin was literally $1 million a coin. And so all of this capital would be flowing into mining, which takes time, right? Like you can't just deploy massive mining infrastructure overnight. That's going to take, months, years to happen. But as that happens, and if the price of Bitcoin remains at $1 million a coin and the price to produce it is still at around $10,000 a coin, then the difficulty is going to slowly start increasing as more hash rate joins the network. And that's going to slowly start rising the cost to produce a Bitcoin for every miner on the network as the difficulty to mine new Bitcoin gets harder, meaning the difficulty is going up. And so I think what has happened in previous Bitcoin cycles and what happened in 2021, and I think will probably happen again when we have another parabolic bull run in Bitcoin, is that the price of Bitcoin gets far overextended for the current level of adoption, right? Like maybe people are buying, $1 billion or like $10 billion a year worth of Bitcoin, all throughout the world. And the miners are selling that Bitcoin. Well, it's like if the price of Bitcoin gets to $1 million a coin, maybe that means we need trillions of dollars of, buying pressure on Bitcoin annually, which, might be completely unsustainable with a 6.25 block reward. And so I think over time, like, we'll have another parabolic bull run. The price will get way overextended because people are buying a lot of Bitcoin in a very short period of time just due to hype, and that price will be unsustainable. And as more miners come on the network, there's going to be more daily sell pressure from those miners because they have to sell to cover their operating expenses. And the price of Bitcoin is likely going to like eventually not keep going straight up and fall back towards its cost of production until we see some of the weakest miners on the network get knocked out. And then historically, when we see some of the weakest miners on the network get knocked out, which we call miner capitulations, that's when the price of Bitcoin is bottoming. So that's the general idea behind the energy gravity model, is that, you know, Bitcoin is a commodity. Cost of production is still very relevant when you're looking at the price of Bitcoin. If the price of Bitcoin is way too far above the cost of production, then it's probably overextended.
Yeah, it's definitely what we saw during the bear market with these miners. You say the weakest miners, and I think what you're talking about is their operational costs and how cheap their electricity is. But also, miners could be really weak because they were just had very poor risk management in terms of taking on way too much debt. And Jesse, speaking of debt, you just wrote a thread on Twitter, and I thought it was fantastic around the United States debt burden that it has, the debt problem. You called it the debt spiral black hole that we're headed towards when we look at the United States fiscal position. And I think it's a really, really important part of the macro picture that everyone needs to be aware of, especially when we think about how it could contribute to potentially Bitcoin's price appreciation, of kind of the problems that this debt imposes on these policymakers and maybe what their responses could be mean to Bitcoin's price. So I was wondering if you could kind of delve into this fiscal position that they're in right now, the problems that you see with it, and maybe some of the possible responses that we might see because of it.
Yeah, I think it's amazing. It's this elephant in the room that nobody seems to have quantified, or at least, like, you know, major news outlets don't spend any time raising awareness to the position we're in as a country. But we now have $31.5 trillion of national debt. We, on top of that, we have $180 trillion of unfunded liabilities, meaning like Social Security obligations that we've pledged, that are not counted as debt because we haven't taken on any money for that yet. We've just promised that we'll pay out a certain amount in the future, so it doesn't count as debt, but it's part of our problem. And somehow, over the last 20 years, we've normalized trillion plus dollar deficits every single year. So right now we're on track for a $2.2 trillion deficit for 2023. We haven't balanced the budget in 20 years, 22 years. And what happens with all those deficits is they add up. They add up to this national debt. And if you make a graph of what has happened to the national debt, it's been absolutely parabolic over the last 15 years in particular. Well, if you zoom out enough, you can see that it starts in 1971, the parabolic growth of it. And that's because in 1971, we went off the gold standard. Suddenly it was possible to run paper deficits, and not have to settle it all in gold ultimately. So we started accruing this debt. The problem with all that is interest expense. And so this is this gravitational pull, this why it's a black hole sucking us in, is if you have $30 trillion of national debt and you have 5% interest rates, which is what we currently have now after a decade of 0% interest rates, that is $1.5 trillion a year in interest expense just to service that debt. Now, we're not paying that right now because it takes time for the old contracts to roll over at the current interest rate. But, you know, it's a matter of time, so long as interest rates stay up where they are at 5%, before we're paying $1.5 trillion a year. And if interest rates go higher, then it's that much worse. And so we're already running a $2.2 trillion deficit. Add on to that an extra $1.5 trillion, of interest expense that we weren't paying just a few years ago, and we got used to that because we had 10 years of 0% interest rates. Now you're approaching a $4 trillion deficit as you know, every year. Where does that come from? You print, so that's spending that Congress is approving in excess of the tax receipts that they're bringing in. And so if you're talking about a $4 trillion deficit, that's a gap that has to get filled somehow. They print the money. They just print it out of thin air. What that does is it confiscates the wealth from the existing dollars, by diluting it, spreading it out. So if you have $10 trillion in existence, I forget what the real number is, but if you have $10 trillion and then suddenly you add $1 trillion, by printing it out of thin air, you're spreading the purchasing power of that 10 trillion original dollars over $11 trillion. So you're diluting it by 9%. And so everyone's existing dollars drops in value by 9% in that scenario. And that's what we do to pay for our deficit spending. And that's what we're going to have to keep doing at an increasing rate because the interest expense is getting so large. And part of that is that, like, we had a decade at 0% interest rates because we were still the superpower of the world. People were willing to take our 10-year U.S. Treasuries for a 1% annual yield because it was considered the risk-free asset for the world. But now we're in such a bad fiscal position that nobody's willing to take on that kind of risk for 1% return. We have to offer more.
Yeah.
So in that sense, the interest rates, the interest expense won't go back down. It can't go back down to where it was. And that's the black hole starting to pull us in because we can't balance our budget. The interest expense we're having to pay is growing more and more. This isn't even addressing the unfunded liabilities on top of that. And it all points to a need to print more and more dollars and dilute existing dollars at an increasing rate, which is hyperinflation. And that's where we're heading towards.
So Joe, you hear that? You hear what Jesse was just explaining. Why do you think it's important for Bitcoin and the future of Bitcoin?
I mean, I think it's huge for Bitcoin, right? I think the dollar is a monetary technology that is designed to debase. Like all other previous monetary technologies that have ever existed, humans are going to find a way to create more of it, whether it's good or bad. And so I think in the long run, it's pretty obvious the supply of dollars is going to exponentially increase for all of eternity. And pretty much the supply of everything else is going to exponentially increase for, forever. And then Bitcoin is going to be this one monetary technology that is not going to exponentially increase. Its supply schedule or supply mining is going to exponentially decrease over time, and eventually it's going to trend to zero. And so it's just going to be interesting to see how it plays out. And I think it's critical to really understanding Bitcoin from a long-term time horizon.
Yeah, and then it becomes an individual decision every day. Everyone in the U.S. and everywhere is making this choice every day, whether or not they realize it, of do I store my value in dollars or do I store my value in something else like Bitcoin? And dollar holders are frogs in a pot that's been put on the burner now. And at some point they're going to want to jump. And if they don't, they'll just watch all of their wealth evaporate as inflation eats all of their wealth. So everybody has that choice to make every single day of, do I jump today? Do I shift from this increasing inflation, wealth confiscation norm of the US dollar, and take a leap into the sweet relief of a hard capped supply monetary asset? Or do I stick with what I'm comfortable with? Because I know the dollar, and even though I'm losing money, I'm comfortable. That's the decision. Those are the things that people are weighing every single day, and it's just a matter of time until more and more people can't stand the wealth confiscation that they're enduring and take the leap to trust this scary new asset called Bitcoin.
Yeah.
Yeah, it's such a yeah, Joe, go for it, man.
Awesome. Yeah. Just adding one last thought. I also think it's critical that people understand what Bitcoin is and take responsibility for truly owning Bitcoin, right? Whether it's, taking 100% self custody or collaborative custody with Jesse's new company, whether you're, an average person or an institution, we've learned what happens when you just want number go up technology, but you don't take the responsibility to actually, have real custody for Bitcoin. You hold it on Mt. Gox and Mt. Gox goes insolvent. You have GBTC and you buy it at a 50% premium and now it's at a 50% discount. Or you or you buy Bitcoin with FTX and all of a sudden now you have no Bitcoin. And so learning to take self custody, whether it's, you hold your own private keys yourself or you have a collaborative custodian like Jesse's company, I think is critical to be able to recognize those number go up properties, those savings technology properties that Bitcoin innately has. You just have to understand and learn and take responsibility for doing that.
Yeah, we certainly saw the consequences of not taking self custody in 2022 with all these crypto casinos blowing up. A lot of people learned that lesson the hard way. And you also saw it in the traditional financial system just last month. Counterparty risk is real, and that's what makes Bitcoin special, is that you can take self custody of it, unlike some of these banks where you hold it and you just have to trust them, with one IOU. Speaking of that banking crisis. I thought it was really interesting how there was some chatter on online about basically blaming Bitcoin and blaming Bitcoiners for the bank crisis. Jesse, you kind of wrote about this a little bit in terms of like jealousy of early holders of Bitcoin, and it reminded me of it a little bit. But do you think that's going to continue as Bitcoin adoption continues to increase, where actually Bitcoin will be blamed for the follies of the traditional monetary system?
Yeah, absolutely. There's no way around it.
Yeah.
Yeah, the analogy that I've landed on here. At first, I thought about how we don't blame people who were early Amazon stockholders. We think, oh wow, they had foresight. They saw where this was going. Good for them. But I think an even more salient example is real estate, particularly in the West. So I'm in the LA area. Here in Southern California, the Mexican government 150 years ago instituted the rancho system, where they granted 10,000 acre ranches to whoever they could trust to take care of the land and preserve Mexican interests. And of course, today there are no 10,000 acre ranches. It's all been parceled off into developments and subdevelopments, and you're lucky if you find a property that's half an acre. And that's the nature of wealth. That's the nature of early adopters. They arrive early. They take a risk. Maybe they have some foresight and see the future value of the thing they're buying. And then the rest of the world catches on. Mechanics play out. The thing they're holding appreciates in value, and they diversify. They sell some of what they bought in order to secure a quality of life that they didn't previously have. Maybe you want vacation properties. Maybe you want a yacht. Maybe you want to own a Monet. Whatever it is. And so you take pieces off your stack, in Bitcoin's case, and buy these other things. And that is what the early whales have done. Some of them are still holding, but none of them have what they used to have. And that process will continue to play out as more and more people arrive to Bitcoin and are bidding up. They're offering more and more dollars per Bitcoin because they want in and they need to find a willing buyer. And that guy who's been holding since 2011, at some point, maybe he's got a magic number at $1 million per Bitcoin. He's gonna cash out some of it and buy himself an island, and then that existing Bitcoin suddenly gets brought into a new family and is somebody else's savings, and the process continues from there. Along the way, we're going to get blamed for everything. It's not our fault that the current monetary system is based on inflation, and Bitcoin is the antithesis of that, because its core value is protecting the rights of holders. And sorry to anyone
21 million.
Yeah, sorry to anyone who puts their value and their savings in this other system whose core mantra is, we're going to steal 2% of your money every year. And maybe we'll steal more than that, and we'll tell you it was only 2%. That's the core difference here, and it's obviously a losing battle. But of course, the establishment, the status quo, is going to blame us for seeking the escape hatch.
Joe, do you have any additions to that?
Yeah, I mean, I hope the world doesn't hate Bitcoiners as Bitcoin adoption continues, or at least the price goes up. But I can see that playing out. I think another point that just came to mind that's kind of relevant is we're talking about Bitcoin being like perfect scarcity, how there's only 21 million. I think a critical component of that people don't understand in like the crypto space is they'll look at things like Ethereum and be like, oh, Ethereum's ultrasound money. It's actually like the supply is decreasing. Well, it's not necessarily like that the supply is perfectly fixed. It's that it's very difficult to change that. That's what makes Bitcoin so special. And humans converge on one best money, right? So we're not trying to trade cows for chickens. We find one tool that we can all use to facilitate trade with each other. And so I think when people compare ETH to Bitcoin, I think they're looking at the wrong thing when it comes to the supply schedule. They should really be looking at, okay, how difficult is it to change the supply schedule? And with ETH and other things like dollars or gold or whatever, it's very difficult to create, or it's very easy to create more. It's simply more easy than it is to create more Bitcoin. No one can change that, and it's very difficult to change that. So I think just a random additional thought that came to my head.
Yeah. I mean, you see that in the charts, right? Yeah. Like the monetary policy charts of Bitcoin, and then ETH, it's just very obviously controlled by humans, and one is controlled by an algorithm, because one is more easy to change. And that is the key point, right?
Yeah, exactly.
Jesse. Yeah, exactly. Jesse, do you have anything to add?
I was just going to add that, maybe I didn't clarify that people will blame us, and they do already. But the better strategy is to join us, because the longer you blame us, the saltier you get, the more you miss out on Bitcoin's mechanics. So, I hope that that's the way it plays out, is that people are bitter. And then they're like, all right, well, I missed out already. I'm not going to miss out anymore. And then you're on the same team.
Yeah. And that's the education component. It reminds me of Safe was on the show last week, and there's a quote from his book. It's difficult to insulate yourself against the risk of somebody else using a money that's harder than yours. And so if they have to be a frog boiling and just wait years and years and years as the people who adopt Bitcoin, their purchasing power continues to increase. They can continuously afford the cost of living as they hold a harder money. We don't want most people to go through that. They can just join us. Yeah. All you got to do is buy Bitcoin,
And on that point of just join us, I think I got to get on my soapbox a little bit and say, like, that's why I'm building this company, and that's why we've built this new collaborative custody company, Onramp Bitcoin. It's to try to make that barrier to entry just a little lower. What this product is whoever's listening to this right now, you're already into Bitcoin, you're stacking sats, you're taking control of your own self-custody. That's what you should be doing. That's the gold standard, and everyone should move towards that. But what I've seen, and everyone in Bitcoin has seen is a lot of people are too intimidated by the prospect of self-custody when they first are learning about Bitcoin. And as a result, a lot of them end up getting exposure to Bitcoin via like GBTC or other crummy fund vehicles,
which has all kinds of problems. Yep.
Yeah, or they end up buying it on Coinbase because it's the biggest name they've heard of, and they leave it there sitting on Coinbase in a big old honeypot. And so what we're trying to do with Onramp is be a bridge for high net worth individuals and institutions who want to have some exposure, want to hold Bitcoin in the best in class collaborative custody model, come in through Onramp Bitcoin. We'll hold your hand along the way and help the educational process until you're ready to take self-custody. And then you can withdraw your Bitcoin and without a taxable event and be a full-fledged Bitcoiner. But it's for those people who are too scared, because it is scary at the beginning.
That's how Bitcoin's supposed to be used, right? Self-custody. That's how Bitcoin is supposed to be used. And I love that, Jesse. I mean, good luck with that endeavor. And, Bitcoiners build in the bear market. But, guys, I could keep talking to you guys forever, but we're out of time. And if you guys could just, first off, thank you. This was an amazing conversation. I love talking to both of you guys, and I love following you guys on Twitter. So why don't you guys tell people where they can follow you on Twitter, or where they can find your work, or just anything that you want them to know about yourselves. Both of you guys, tell them where to find you.
Cool. Yeah, I can start it. I'm Joe Burnett on Twitter. I Capital is my Twitter handle. And it was an honor to be here with Jesse. I know we were both talking with each other on Twitter years ago, both as like basically anons, and had a lot of cool conversations with him over the years via Twitter DMs. But yeah, you can check more of my work out at blockwaresolutions.com. Also, you can DM me on Twitter. And also, I work for Blockware Solutions, so we just launched the Blockware marketplace where you can buy and sell ASICs. Definitely check that out if you're interested.
Yeah, it has been very cool to see Joe become like the expert on certain aspects of the mining space, absolutely owning it. So everyone should totally follow Joe, and the content that he's putting out through Blockware is awesome. I'm also on Twitter. I go by Croesus there, Croesus. But lately I've been focusing my efforts on growing my Substack, where I put out a weekly Bitcoin and macro update. You can find that at Jesse Myers, JESSEMYERS.substack.com. Nice. And you can subscribe for free. And if you love it, after a while, you can upgrade, but subscribe for free.
Cool. Yeah, check it out. I highly recommend both these guys' work. You guys do great things for Bitcoin. So thanks for educating everyone. And thanks for coming on the show, guys. And have a great day. I'll see you guys around.
Thanks, guys.
If you care about your financial future, you need to check out a couple of our offerings, including Swan IRA and Swan Private. Swan Private is our white glove concierge service where you get a trusted partner on your Bitcoin journey. We offer all kinds of education and research projects, as well as exclusive events to our Swan Private customers. Check it out today at swan.com/private. Also, Swan IRA. Swan IRA is the best way to gain exposure to real Bitcoin in a tax-advantaged account, like a traditional IRA, a Roth IRA, or rolling over your 401k. So if that interests you, check it out at swan.com/IRA today.